first time in what feels like forever, we have good news in crypto. That's right. Lots of good news that we got to cover here today. Not just the price action that we're talking about, but also the new Fed chairman. It's not confirmed yet, but the guy that's seen as the front runner is someone who is very, very favorable to our little market here, and we should all be very happy about that. We're going to do a full analysis on it and tell you exactly what to expect if our dreams do come true. Also, what is the ESLR? You've probably been hearing a whole bunch about that lately. What exactly is it, and why should you care about it? And what is causing today's pump? All this and more on today's very special episode of Shut the Fud Up. I'm Cairo Copeland, and this is Reinvent Ideal. Welcome to today's program. And you know what? Maybe I should just say it like this. Welcome to today's program. Because there's one guy in the comments on my last stream that said I talk way too slow and I need to speed it up. And oh my God, how horrible. He had to turn it on 2x speed. Oh, can you imagine how awful that must be? That you have to take your phone out of your pocket and you got to unlock it, and then you got to flip a setting to make a stream be how you want it to be. Oh my gosh, how horrible that we live in this age of technology where you have the ability to do that and you're being forced to do it. Oh, I'm so distraught. How could anybody allow something like this to happen? I mean, it just makes me think that the person that's talking way too slow, I just want to yell and scream at them precisely this.
Control yourself!
For real. No, not to give him too much trash. I do understand if a streamer is talking way too slow, and the majority of the time, people are listening to streams. They're not actually watching them. But I do understand it gets pretty annoying when it's slow. I mean, have you been watching BitBoy lately? It's awful. It's unwatchable because he is silent for about 75% of all of his streams. This is BitBoy. This is what he does. Welcome to BitBoy Crypto, and today what we're going to be talking about. And it's just like that. It's that cadence. It's so slow. And it's like he's thinking on the spot exactly what he's going to say. He doesn't actually say it or anything. See, some of you are already signing in right here. Checks my pulse is in here. We've got Orez. Orez in here. SW. Oh, yes, happy Thanksgiving, everybody. That's tomorrow, by the way. And you know what? I got to tell you something. Like, Thanksgiving is probably my second favorite holiday. But we're going to do this here. If you guys in the chat can guess what is my favorite holiday. Some of you might already know. Then some of you will be like a complete surprise. Like, oh man, there's no way I would have guessed that. But yeah, Thanksgiving is one of my favorites, mainly because it just doesn't get its flowers, I think. Because here's what the year's like. Right after 4th of July, it's immediately spooky season. All anybody's talking about is Halloween. Because, you know, Labor Day is a communist holiday. Screw Labor Day. We don't care about that. But after Halloween's over, or even sometimes like before Halloween even happens, people are already putting out Christmas stuff and are immediately skipping over all of the other holidays, and that upsets me. That makes me so upset. SW, no, it's not Veterans Day, but you're close. You're very close, actually. What was I saying? Oh, yeah. It really ticks me off that we just skip right past Thanksgiving and go straight to Christmas, because you know what it is. It's all just a bunch of materialism. As everybody's just like, oh, why should I be thankful for what I have when Christmas is just around the corner and I can ask for more stuff because that's what I want, more stuff. Give me stuff. Be thankful for what I already have. Hell no, give me more stuff. That's exactly how I see it. Everybody just skips right past. Like, fuck Thanksgiving. We don't need no Thanksgiving. We don't need to be thankful for anything. Yeah, we do. We should be very thankful for everything that we've got, and we need to have a lot more gratitude in this country. Because even with the pain that I know you guys are experiencing out there with how crypto has been acting like an abusive spouse to you lately, even with all that, there is still a whole bunch for us to be incredibly grateful for us to be incredibly happy with. I mean, days ago, here's why I haven't been streaming much lately, is I've been getting a head start on next year's taxes. And as I was doing my taxes, I did a lot of tax loss harvesting with crypto, which maybe we'll talk about that a little bit later here, where you can sell down some of your assets that are at a loss and use that loss to reduce the income or the capital gains that you have to report on the rest of your crypto if you have any capital gains. And if you don't have any capital gains at all, well, you can use $3,000 this year to write down your personal income as well. But then everything else on top of that, you get to carry it forward into next year. I'm expecting a great year next year, so I want a whole ton of losses to carry forward and offset the gains that I'm planning to take next year. But when I was looking at it and how bad some of my losses were, man, it was very, very painful to look at. Like, oh my God, that much money. It was like, you look at it and you compare to years of income that you've had in the past. Or, I mean, not that I lost years of income, but I'm thinking like, what was my annual income when I worked this job, when I worked that job? And to see your capital losses stacking up to be as great as a year of income at a previous job I had, particularly when I was a financial advisor. That's hard to look at, and it just depresses you and everything. But I had to remind myself, you know what? I live in this great country where I get to use these to reduce my taxable income, my tax burden, which is the fee that I pay to live in this great country. And then I can also use leftovers of it next year. So if you don't know about tax loss harvesting, and if you also don't know about wash sales and how they don't apply to crypto, man, that's something that is you really want to know about, because it's something that can do a whole lot of good for you, help you save a whole lot of money on your taxes, particularly with the whole wash sale rule not applying. Because what that is, we'll just cover it real quick here. What the wash sale rule is if I'm at a loss in one of my positions and I sell it to use that loss on my taxes, I'm not allowed to buy that position back until after 30 days has passed. The IRS says you need to feel 30 days of pain before you can get back into it. Otherwise, if you buy in before the 30 days is up, it's called a wash sale, and you cannot use the tax loss. But that doesn't apply to crypto. That applies to stocks, that applies to bonds, mutual funds, ETFs, just about every other asset out there. It does not apply to crypto. You can sell an asset, you can sell a cryptocurrency, and then buy it right back that exact same day and still use the loss on your taxes. All right, because crypto is not a security. The wash sale rules only apply to securities. Now, make sure you check with your tax advisor before you try pulling this stunt. But I did it last year, and it was great. It really helped me save a ton of money on my taxes, because it was also the same year that I sold a business and had a lot of capital gain from that I wanted to offset. And doing it this year, though, like some of the stuff that I sold, I'm not actually going to go back into. I'm going to leave it sold. I will also say I would not do this with any pulse chain assets. I wouldn't do it there just because the liquidity is so low on pulse chain in general that, like, when you sell, you're going to push the price down pretty far. And then when you go to buy back in, you're going to push the price up a lot higher. And that's just going to be an overall net loss that you won't get back until the chain comes back. So don't do that with your pulse chain assets. In my opinion, that's not what I would do. All right. Still, nobody has been able to guess what's my favorite holiday here. Y'all keep guessing at it. Let's see. Checks my pulse says my wife makes the most delicious, juicy Cape Verde turkey. Could really go for some of that. My favorite turkey is the big Renaissance Festival style turkey legs. That to me is like the best tasting type of turkey in the entire world. So, before we get into today's top stories, let's take a look at the things that we look at every time that I do a stream. Come to that chart later, but look at this! Finally, some good news! Isn't it? Bitcoin is back above $90,000 and it is comfortably above $90,000. Isn't that incredible? After this whole past couple of weeks of getting beaten down, we are finally seeing some really nice action here for the price. And it's possible that we may end the month positive. I mean, there's a few more days left to do it, just about 4 more days left where it could do that. And it certainly is possible that we end the year positive. Some people are thinking that, hey, maybe the real top is going to come in December, or some of the 4-year fundamentalists are thinking that. Like, that's a Benjamin Cowan thing. He thinks that if we do have another run up, well, then the real top Bitcoin will be in December of this year. And then he's thinking everything's going to play out like it always has, where then we have a few weeks of alt season going into January. Which, hey, you know what? If that's the case, I mean, I actually hope that the 4-year fundamentalists are right, if that's their base case, that we get another top and then we get an alt season after. Like, if it plays out that way, I'm totally cool with that. I'm fine with that, even though it makes no sense to me why it would do that. But I'd be totally cool with it just because, man, I really don't enjoy crypto as much as I thought I would. I really don't. Like, I would love nothing more than to sell all my assets, go to Puerto Rico. I mean, I can't do it this year because there's not enough time left in the year for it to work out. So I have to wait until January anyway to do that, to do the sales. So I can go to Puerto Rico, pay the zero capital gains in that case, and then not have to do this anymore. And I don't mean not have to stream, but like not have to stress about markets. And when that does happen, like when this cycle really does end, I'm never talking about crypto ever again, just because of all of the stress of the markets and everything. I'm not talking about it ever again here. I'll still stream, but I'll be talking about something else. You guys can probably help me pick a subject. Might be movies. I like talking about movies. Or go back to my old business, which I still do, but the coaching men, I still do that, just don't do that much of it lately. Because this is what everybody's concerned about, is money. But looky here, man. We got some great performances across many assets. I mean, even the piece of trash known as Ethereum is actually performing very well. Might have something special to say to the Ethereum holders today. If not today, then maybe it'll be next time. But it's back above 3,000, which is an important psychological level. Ethereum is still a piece of trash, and you shouldn't hold it. But still, it's incredible that it's going up above 3,000 again here. XRP is doing pretty good here, up 7% on the 7 days, and Solana is reclaiming some highs. Hyperliquid is kind of stealing some headlines right now with a 12% pump on the day. But then taking a look at everything else right here, like, this is how you know we're okay, is look at World Liberty Financial. It's basically kind of stayed within that 14 to 16 cent range for all of the chaos of this past couple of weeks. So because the coin that is kind of the favored coin of like all the Trump insiders has stayed within a pretty tight range, you know that we're going to be okay here. Now, when something like World Liberty Financial capitulates without like a good reason why, that's when you know we're in trouble. All right. Now, taking a look at everything else right here, Caspa is also stealing the show. It's got an incredible run that's been going on this past week. It's almost tempting to a lot of people to get them to want to buy. I don't know so much about doing that. Not that I got anything against Caspa, but I don't like to buy stuff after it's had a double-digit daily return, because I look at it and think, oh, I'm too late. Pendle is another one that's been having an incredible week. Here's the interesting one. Mantra was an incredible performer in 2024. But then when the year turned around, something strange happened where it just got socked right in the face. It's like somebody just hit it right in the head with a baseball bat and knocked it right down. And still to this day, nobody really knows why it took such a giant dump, going from almost $9 to now less than 10 cents. But this movement that it's having right here is incredible. And I think a lot of it is just due to the fact that its price is so low and its liquidity is so low that it doesn't really take that much to move the needle on it. Kind of like what we saw with Root a couple of weeks ago. And that's probably the case for like a lot of these coins that are having their runs right now, is that the price is so low it doesn't take that much to move it right here. How about the Pulse Chain ecosystem? What's going on there? Oh my goodness, finally some green. Here's something that I really got to hammer into all you guys out there. A lot of people thinking, oh, we're cooked. It's never coming back. We're all going to be poor. Oh, that's what you hear from all of these people that are whining and crying and bitching and moaning about the prices of the Pulse Chain assets. Guys that are, let's just say, a little chunky in the midsection, or they're pretty wide, yet they just can't help but keep posting videos of themselves working out at the gym, more so like they're trying to convince themselves more than other people that they are not out of shape. That's what it seems like to me. But they keep going, oh, the price is never going back up. Look at this here, guys. I'm not saying that these are great numbers here and everything, but do you notice how when the whole market is going up, we go up with it? Look back at 2024. There were 2 times that the Pulse Chain ecosystem had amazing runs and high prices. That was in March of 2024. That was in December of 2024. So too was the rest of the market. When they go up, we go up too. We are not ostracized. We are not going to miss out. We're not missing out on a damn thing. When the market does well, we will do well. When the market is not doing well, of course we're not going to do well. Y'all need to get it through your thick skulls. And I'm not talking about you people that are watching me. Obviously, you guys get it. I'm talking about all of the stupid imbeciles. And I mean, I'm trying not to cuss here. I'm really making a conscious effort to not cuss. But all of the idiots on X that are constantly whining and complaining, going, oh, this is what I got to say to you guys.
Sometimes you just got to shut the FUD up.
Seriously, you guys are so stupid thinking that we are just uniquely cursed and fundamentally damaged, and because of the pain that we've gone through, we're never going to come back from it, and all you guys are just going to go, when the bull run really happens. I'll tell you what, when the bull run really gets started, that is one stream you do not want to have your kids listening with you. Because I'll tell you, on that stream, I'm going to be doing a whole bunch of things here. One, I'm going to show you one of my stripper routines on the pole. So, of course, there's some adult content in that. But 2, I will be talking so much trash, and I'm going to be calling out people by name. I will absolutely be naming names when I call people out, and I will rip them to shreds, and I'm going to use the foulest language that will make a sailor blush. I'm going to be saying more cuss words than I've probably ever said in my entire life on that stream. All right, and I'll have you'll know it's the stream here because the thumbnail will say bull market begins. And when that does happen, man, I'm calling out every single one of these whiners and complainers, and I'm going to sing this song.
Hey man, just want to let you know that sometimes you gotta shut the fuck up. And this current time is just one of those times you gotta shut the fuck up. I don't think you're a bad person, I just don't want to hear you talking anymore. You gotta shut up.
All right, everybody, I see some questions piling in. I will get to your questions, I promise, by the end of the stream here. But this is finally some good news, and it just proves what I've said all along. You can't expect your ecosystem to outperform when the overall market is taking a dump. Every time you saw Ivan on tech posting a bunch of negativity going, Puffacans, why is your ecosystem down? Aren't you guys concerned that you're going to miss the bull market? You're going to miss the bull run. Oh, yes, yes, yes. We are pushing the button, and oh my gosh, there's all this Fugazi. I just want to, would love to I'm not going to say it. I'm not going to say it here. I'd probably get kicked off of YouTube if I say what I really want to say. But what I told him every single time was, yo, Ivan, check the rest of the market. It's down. The whole market is down, so of course we're down. But that never made it through his thick Swedish skull. How's the rest of the world doing, particularly TradFi? Let's refresh here. We had a good day in the stock market. Woohoo! Absolutely a good day. But what else we have to going on here in like the stories on CNBS? It looks like we're gonna have a nice close to the month here in TradFi. And I'll tell you, the reason why TradFi is going up is the exact same reason why we were going up today. That's going to be the top story of today. But a big contributor is this. Here's some really, really good news. The dollar index is back below 100. Let us all hope and pray that this is the start of a trend that continues downward. Because, man, up earlier today, right here, it was almost above 100. It was pretty close to it. And let's see, when did it actually break this here? I think it broke it back on not too many days ago here. Probably about 3 days ago is when it broke. Oh, no, yeah, on the 21st is when it broke it. And it had been up in like the, it had been like the 24th. Been up in the high 90s for a while, the high 99s. Now it's at 99.5. It only has a little bit of a way to fall here before it hits 98. This is great news right here because you see what this tells us is that if the dollar is getting weaker, well, then everything priced in dollars is getting stronger. What's priced in dollars? Yes, financial assets. Here's some more good news. Look at this. The U.S. Treasury, the 10-year Treasury, is down below 4%. This is incredible. I mean, it's not as great as it. I mean, it had been lower before. It had been down to like 3.95 at one point. And this here, 3.99, that's not anything to write home about just yet. But bringing the long end of the Treasury yields down, what that tells us is that there's a lot of money that's piling in to these treasuries and is reducing these yields, and it is forcing people into the riskier ends of the curve. Why are people piling into it? Well, you got to remember what kind of goes in to these treasuries, to particularly the 10-year, is estimations on future growth and inflation over the next 10 years. And some people think, well, if it's a growth estimation, don't we want the 10-year treasury to be very high? Not necessarily, because you got to remember, these things don't exist in a vacuum. These things have, they're part of a larger ecosystem of what determines growth and inflation. But when we have a 10-year treasury coming down, what that's going to do is that's going to force a lot of other large investors, particularly the big institutions, to have to go elsewhere, such as further out on the risk curve, to find their investment, find the returns that they want. Because maybe there's some endowments or some institutional investors or insurance companies where in the charter it says they must get a 4% yield on any bonds they invest in. They can't do the 10-year treasury right now. They got to go invest in other kinds of bonds like corporate bonds or longer dated treasuries. And they're pushing their investment further out on the risk curve, which pushes the investment that's already there further out on the risk curve. What's at the very end of the risk curve? Cryptocurrency. So when people are forced to take on more risk, it doesn't necessarily matter what they invest in to take that risk. It all helps cryptocurrency. You see the evidence of it today. I know that there are a bunch of jerks out there who refuse to get on a stream with me and debate this with me or just have a discussion with me about it. There's a bunch of jerks out there who insist, oh, no, Cairo, you don't know what you're talking about. That's not true. I mean, look at Bitcoin. It went up despite all of this. But here's the proof right in front of your very eyes. This is why the only person you need to listen to, the only streamer you ever need to watch is me. Screw all the other guys. Screw Ivan on Tech. He's an absolute imbecile. Screw BitBoy, because all he does is he just talks like this with very slow cadence here. And yeah, you guys, I'm going to cover this here today. And man, I don't know. You don't need to be watching him. You don't need to be watching Rand Nooner who talks like this and goes, oh, yes, guys, look at the crypto bubbles. Oh, let me close out the post chain right here because I don't want that. You don't need to be watching him. You don't need to be watching George from cryptos are us. Who sounds constipated every time he talks? Well, George, and I'm so constipated. But welcome back to Cryptos R Us. You don't need to be watching him. You don't need to be watching Wendy O. You don't need to be watching any of these other schmucks because none of them know a gosh darn thing, or they at least don't know what I know because they don't share it with you. This should be a story that every one of them should have been talking about today, and they weren't talking about it because they just don't know because they're just not investment literate. They're just a bunch of people that got lucky early on when they got into crypto and decided to stream on it. And because many of their crypto bags are down, they do the streaming for the income primarily. And that's why many of them stream every day. Me? You see me streaming every day? No. I only stream when I got something to talk about. Here's something to talk about. But let's also kind of do the flip side of this. Baked in to the 10-year treasury is an inflation estimate because you see the bonds in general are allergic to inflation. Like when they believe inflation is coming along, bond prices are going to come down, which pushes the yield up. And when it's expected that inflation will be high, well then of course the yields will rise because you have to increase the interest rate that you're paying out to not just meet inflation, but be a little bit above it, because when you subtract the inflation from the interest earnings, it's less than what the stated rate was. And of course, in order to attract people to buy your bond, your interest rate or your yield has to be higher than inflation. Otherwise, people have no reason to invest in it. Like if it's less than inflation, I mean, you're immediately losing money right then. So that's how the treasuries work here. So it's good that this is coming down. And what we really want to see, though, is we want to see the federal funds rate come down a lot faster. It's already lower than the 10-year, but we also want to see it get lower than the 2-year, because right now the 2-year is much lower. We want to see those yields converge and have the federal funds rate be lower than all of the yields that you see here on this chart, particularly with treasuries. We want to see it lower than the 9-month. It's currently higher. We want to see it lower than the 1-year. It's currently higher. We want to see it lower than the 2-year. It's currently higher. And speaking of the federal funds rate, it is now expected by 84% that there will be an interest rate cut in December coming up at the meeting they're going to have on the 10th. All of that drama, all of that whining and complaining and panicking and acting like a bunch of idiots, selling down the prices, seem to have all just been based on the fact that everybody thought that, oh my God, what if they don't raise interest rates? And so everyone capitulated and they failed to heed a warning that I've been shouting, or a plea that I have been shouting for a very long time, which was this.
Control yourself!
No, they just couldn't do that. They all had to go, oh my gosh, what if they don't raise interest rates? What are we going to do? And it's looking like maybe it was all just an act. It was all just a hoax. That maybe Jerome, good old J. Powell, was saying it's not a foregone conclusion just to screw with you people. I got a feeling that that's what the case was here, that he said that just to screw with everybody because he finds it funny just how y'all analyze every single word that he says and takes it as just like this straight gospel of unquestionable law. His word is law. And we should base all of our investments off of everything that he says. Even if he sneezes, we should base our investments off of his sneeze. If he burps, if he farts at the next meeting, we need to base our investments off that. Oh my gosh, what did that fart mean right there? I mean, did that fart have any sort of hidden subtext to it? Oh yes, I think that fart truly did there, because, it sounded like it squirted out into the pants right there, and that tells us that there's going to be a very slow drip of liquidity into the markets. I'm sorry. Sorry, guys. I know that's getting disgusting, but can't help myself. I think Peter Schiff did a stream recently saying that he thinks that the whole interest rate to cut or not cut fiasco of the past month has all just been one great big hoax. And you know what? I tend to agree with him on that. When me and Peter Schiff agree on something, you know it's correct here. Now, before we get further into today's stream, I want to present this to you here. You see this book? It's called Your Parents Were Wrong, Debunking and Replacing Outdated Advice. If you want a copy of this book for free, I will give you a copy of this book for free. That way you don't have to pay the $43.73 for it. That's not what it really costs, you guys. You see, that's I'm using a VPN, and apparently that's what it costs. And where am I? Costa Rica or something? I don't know. Don't know where I'm at, but $43.73 is where it costs from where my VPN is. But you don't have to pay that. Matter of fact, you don't have to pay anything at all for a copy of this book. All you got to do is just head on over to my Substack, which is reinventideal.substack.com. I repeat, reinventideal.substack.com, and just click right here where it says free gift, and then scroll down here and subscribe to my Substack, where I will then email you a free copy of this book. It's called Your Parents Were Wrong. And that will destroy all of the bad advice that your boomer parents ever gave you. Like, oh, make sure you buy a house right now. Make sure you get a nice 9-to-5 job and invest in a very well-diversified portfolio of stocks, bonds, and mutual funds. That's the way to do it. I take all of that advice and I just stick it right into a shredder and tell you the real advice, the difficult conversations that your parents didn't want to have with you because they loved comfort more than they love you. And that's true. Now, back to what's going on here in the markets. What is going on here in the market? Seems like the gains are kind of paring down just a little bit right here, but let's take a look at the overall story. The market capitalization of the crypto space, it came down tragically down to about 2.8 trillion. Falling below 3 trillion is a very rough psychological number for a lot of people out there. Some just can't handle that. How did Bitcoin dominance do? It really hasn't budged that much. It's at 58% here still. I think it does go back above 60 before it comes down. I think that's very likely that occurs, because what it means is we're getting one more Bitcoin high before any sort of alt season occurs. But here's the thing that everybody's been paying attention to, and that is the fear and greed index. Look at this thing. We've now been in extreme fear territory longer than we have been in that territory for the past 2 years. We have not been in that extreme fear territory for this long since 2022, and a lot of people are thinking, well, yeah, that's because the bear market is starting. Sure doesn't feel like a bear market right now. I mean, all year long, it's felt like a bear market if you ask me. But compared to what? I mean, if anything, if you're comparing it to 2024, okay, maybe I'll agree with you then, because 2024 felt a lot more like a bull market top. I mean, look how long it was up in extreme greed at towards the end of 2024, like from November the 10th all the way to December the 7th, or really December the 9th. This thing was up in extreme greed. To be in extreme greed for one whole month, that is characteristic of a top. To be in extreme fear for as long as we have, about 2 weeks, going on, well, actually more than that, right? No, about 2 weeks, right? About 2 weeks is how long we've been into it. We've been in fear for a long time, but this current trend here, this started about 2 weeks ago. That is characteristic of bear markets. And some people think, well, yeah, that's because the cycle ended on October the 6th, 2025. No, it ended long before then. It ended all the way back in December 2024, because that was where we had extreme greed, and now we're in extreme fear. Man, quite a difference a year makes. Just how different the market's been behaving this time around as opposed to this time last year. But why am I bringing this up right here? Well, good old Brett has posted this little tool that we got here and on his website at investandhold.com, looking at the fear and greed index. And here's what we like about this here. Let me zoom in a little bit more here, because like what you can see is that in bear markets, that's where we're in extreme fear for very long periods of time. And they're all buy-in opportunities, of course. Like that's the time you want to be buying, is when others are fearful. We always seem to get them either before a downtrend. We'll take a closer look, though. Take a much closer look here, though, at the 2018 bear market. We hit extreme fear, then go down a little bit more, but the next move is a move right up. So looking at this chart here, it seems that anytime we hit extreme fear, it was always a good time to buy, especially when we stayed in it for a long time. Like this one right here, kind of like the bottom of the 2018 bear market. We first got into it probably around November 18th, and then finally got out of it a month later. So if this extreme fear period lasts for a whole month, well, then we know that there'll be good times ahead. Or we can suspect that there will be. Here's another one, March 14th. Remember what was going on in the country at that time? Or actually, it was March 11th. Remember what was going on in the country or in the world around that time? March 11th, 2020. And then a month later, we finally got out of extreme fear. Man, had you bought in right there, you just had the generational buying opportunity of the century. Now, you may also remember in the 2021 bull market, there was some doldrums kind of right in the middle, where we were up at a new high of about 63,000 in April. And then we had a very painful Bitcoin summer where it went all the way down to 29,000. So it got chopped in half practically. Lots of extreme fear throughout the summer, but then it went away in July, and that would have been a great time to buy. Take a look here. Lots of extreme fear in 2022. I mean, this right here was Terra Luna. Probably not a good time to buy right here. A lot of people were thinking, oh, yeah, that'd be a great time to buy in extreme fear of May 2022. Oh, no, that'd be a bad time because look what happened. The thing went all the way down to $19,000 in just a month. It was still a great place to buy right there, though. But, of course, it went lower. Went lower all the way to 15,000 in November of 2022 as well. Surprised we didn't really get a lot of extreme fear back then, but I guess people were just so used to the pain at that point of that bear market we were in, because 2022 was a very brutal bear market. Now, it seems here we didn't get any of it in all of 2024. That's how you know 2024 was the real good year, with what I think was the true cycle top for crypto as a whole, not Bitcoin, but for crypto as a whole. That was the cycle top. And then 2025 is our bear market year, because now we started getting extreme fear all throughout, particularly right here. Now, the first time that we enter it, like this one right here, was on November the 12th. First time that we enter it, that's not necessarily the time to buy, because we can take a lot more hits afterwards, as you saw throughout the past 2 weeks. But once we've been in it for a while, well, that's when you know, like, hey, ain't anywhere else we can go besides up in that case. Yeah. Next thing right here is a little story I found about the fiscal dominance that Lynn Alden talks about. If you don't know what fiscal dominance is, this is something you definitely want to know about. Something you definitely want to know about, because it's the reason why the bullish moves that we're going to get in the future, it's the reason why I think 2026 is going to be the really good year ahead. Because when you take a look at the white box and what that's denoting here, I mean, what this is showing you is government contracts and revisions of the long-term trends and everything. This is specifically for a company called Accenture. And Accenture is a consulting company that deals with other companies that get government contracts. And right around this time here, this was in May of this year, they realized, hey, you know what? All of this talk of the Department of Government Efficiency, DOGE, is really just talk. They're not going to do any cutting. So we can go back to consulting our clients by telling them, hey, you know, the government's going to waste a lot of money. Why don't you get in on the waste here and pocket some of that money for yourself? That's what Accenture does. All right. The reason why that was the case is fiscal dominance. Because what's happening here is the government, they were saying, yeah, we're going to be responsible now and start doing some cutting, but they didn't. Instead, they decided, oh yes, all of the Doge cuts and everything, all of the discoveries, we're just going to keep them as they are. We're going to keep pissing away very good money. We're going to keep being completely irresponsible because the economy of the United States of America is dependent on the government wasting money. Meaning, if they did the Doge cuts, we would have had negative GDP. Not saying that I like that. I'm not saying that I want them to continue wasting money stupidly. I'm just saying that as a matter of fact, because that's all it is. It's just a matter of fact that if they did any of those Doge cuts, it would have just reduced GDP because much of our GDP is dependent on government deficit spending. And that's what Lynn Alden wrote about here when it comes to fiscal dominance. This means nothing stops the train. The government is going to keep spending money that they don't have because all it is it's just politicians giving away a bunch of goodies to get reelected. And they piss that money away. And now the Federal Reserve is going to have to make favorable financing conditions for them to piss that money away. That's all that's going on here. That's what we mean when we talk about fiscal dominance. Now, another thing that's related to this to talk about is what's called the ESLR. You might have seen this in the news a lot lately or on X to talk about the ESLR. And what that is that's the Enhanced Supplementary Leverage Ratio. Try saying that 3 times fast. That's why we just say ESLR. And what that is that is a regulatory capital requirement that is imposed by U.S. federal banking regulators. And it is imposed on what they call GSIBs, which means globally systemic important banks. So it's just JP Morgan, Bank of America, Citigroup. They're saying, hey, these banks, they are the banks that are too big to fail, and we're going to regulate them with what's called the ESLR. And again, that is the Enhanced Supplementary Leverage Ratio. Now, there was a story on this here that I was going to bring up. Where did I have it? Did I have it up here anywhere? Maybe I didn't have it up. That's fine. Like, we don't really need to look at the story on it here because, to be honest with you, like a lot of this is stuff that if you're a person that gets laid regularly, you wouldn't know this stuff. Only nerds who don't get laid know about this. But what it is it acts as a backstop to traditional risk-based capital rules by mandating that these banks, the GSIBs, maintain a certain ratio of high-quality Tier 1 capital, like common equity, to their total leverage exposure, which includes all of their risk-on and risk-off assets, all of their on- and off-sheet balance sheet assets without adjusting for risk levels. So what this means here is that low-risk assets like U.S. Treasuries are treated the same as high-risk ones for calculation purposes, requiring the banks to hold capital against everything at full value. It's incredibly burdensome to those banks that we view, or we tell them that, hey, those treasuries you got, it's nice that you got treasuries on your balance sheet, but them being risk-free assets doesn't count in reducing your ratio. You would think that they would be like, well, we got mostly risk-free assets, so we don't need to have like these large capital ratios. But the regulators say, no, you do. And that all comes from the Dodd-Frank Act. This came after the 2008 financial crisis, and Dodd-Frank enforced this on us. They said, well, the original purpose was to enhance financial stability and ensure that these massive institutions had enough loss-absorbing capital to weather economic shocks. And that way, we don't have to do taxpayer-funded bailouts when there's a big collapse. And it was enhanced. It was enhanced beyond the standard supplementary leverage ratio, which was just the SLR, specifically for these banks to account for their outsized impact on the global economy. Because you see, like if Bank of America fails, well, that's a big story all across the world. So that's a huge implications for the overall economy, not just from like the actual loss of capital, but also just from the stories and speculations that are going to be coming from it when that becomes a big story across the world. So in the old rules, the deal was you needed at least a 5% ESLR at the holding company level and a 6% ESLR at insured depository subsidiaries like the bank branch for Bank of America down the street. And that way, if you had those ratios, you weren't restricted on doing things like paying dividends to your shareholders or doing stock buybacks or having executive bonuses. Because that's how they regulate it, is they put restrictions then on what dividends and you can pay out or how much you can pay the executives. Why does this matter? Like, why do we care about this? Well, I'll tell you why. It strikes a balance between preventing bank failures and influencing market behavior. Because you see, on one side, what you got is an ESLR that promotes resilience by forcing big banks to keep more capital on hand, which can limit excessive risk-taking and protect broader financial system integrity. But on the other hand, its uniform treatment of assets has been criticized for discouraging low-risk activities like holding large amounts of U.S. treasuries for market-making purposes, which can strain liquidity in critical markets, like particularly with the volatility spikes that we saw in repo in 2014, 2019, 2020, and right now in 2025. A lot of the repo chaos going on right now is due to the ESLR, and it views treasuries as a risky asset that is equally as risky as, say, your company's stock. So it has broader implications for the economy, like the reduced treasury market liquidity can increase borrowing costs for the government and ripple into higher rates for consumers and businesses all across the board. So, as of right now, U.S. regulators just finalized a rule, and the regulators specifically are the FDIC, the Federal Reserve, and the OCC. They just finalized a rule that will take effect on January the 1st of 2026. This is another reason why I think 2026 will be a good year. They're recalibrating the ESLR to better align with what's called international Basel standards, and those are just banking regulations for all banks across the world. And it addresses the liquidity concerns. So this is all helping create more liquidity, which is what we need for our assets to go up. And they say, well, a fixed 2% buffer, we want to replace that now with a dynamic one equal to 50% of each one of these banks' risk-based surcharge. See, currently it ranges from 1% to 2.5%. That will then result in an overall ESLR of about 3.5 to 4.25% at the holding company level. Currently, that level is 5%. So bringing it down to 3.5 to 4.25 or somewhere in between there, that would have an amazing positive effect on liquidity all across our economy. And this is expected to free up lots of money, lots of capital Some people estimate that it's anywhere between 13 billion net to 200 billion in shifting. That doesn't sound like a lot of money, but what we're talking about is money that's already on bank balance sheets. Like once we get them moving and everything, and they can hold more low risk assets, that will be a liquidity injection of about $1 to $2 trillion of liquidity into our economy. $1 to $2 trillion liquidity injection. That is not as big as what we got probably back during the pandemic in 2020, but it's big for right now, and it will have a big effect right now. So macro communities, crypto communities, they're all talking about this. They're talking about it as stealth QE. That's how they're referring to it, stealth QE. It's another form of quantitative easing, but they don't call it quantitative easing because it's not expanding the Federal Reserve's balance sheet, but it's going to have the exact same effect. It's going to have the exact same effect here because what it's doing is it is injecting more liquidity into the economy, and that can boost asset prices for stocks, for Bitcoin, for your altcoins, because it's easing financial conditions without direct Federal Reserve money printing. They like that because nobody at the Fed wants to really do quantitative easing, all right? Even though that's what we want them to do. I mean, they would only do it if it was an absolute emergency, like the yen carry trade unwinding, which could still happen, by the way. It's looking very much like the Bank of Japan will raise interest rates. And I think that come December 18th to the 19th, when that meeting happens, when they make that announcement, you could see the carry trade unwind in the next few days. You'll certainly have a really rough stock market day that day, I think, and probably a rough crypto market day. But when they do this here on January the 1st, when they introduce the new ESLR regulation, that is going to be a $1 trillion liquidity injection. And that is going to also shift liquidity control more toward the Treasury Department, with potential future steps like exempting treasuries from the ratio under a new Fed leadership, which we're going to talk about next. But critics, what they're saying about this, people that are talking bad about it, is they're saying, it's raising the odds of bank instability. And they also say that it works against having an efficient market. Like, guys, there's no such thing as market efficiency. No such thing at all. Particularly even with everybody doing index funds, that's actually created a lot more inefficiency in markets. So the critics, they're all just a bunch of hawks is what they are. All right. So now what we want to talk about next here is the top story, which is our potential new Federal Reserve chairman. But before we get into that, got a little PSA for you.
Why does crypto suddenly explode into unbelievable bull runs, only to crash just as fast? It's not luck. It's not random. It's macroeconomics. In decrypting crypto, you'll uncover the hidden forces driving every major crypto rally, forces tied to the global debt machine, central bank liquidity, and repeating market cycles. This isn't another blockchain basics book. This is the blueprint Wall Street doesn't want you to read. The playbook that shows you why crypto moves when it does, and how to spot the next bull run before it starts. Don't miss the next cycle. Read Decrypting Crypto. Arm yourself with the knowledge to ride the wave before it leaves you behind. Decrypting Crypto by Cairo Code. Available now on Amazon and Audible.
If you don't know, well, the purpose of that book is to explain to you in very plain English, understandable English, why crypto goes up. Like, here's why I do not have that much respect, or I don't lend that much credibility to the people that are saying the cycle is all over right now, because none of them could tell you why the cycle even happens in the first place. Got into it with a guy that's big in our community right here. Like, hey, can you even tell me like why the crypto cycle happens? Like, what causes it to occur? What guides it? What governs it? What drives it? He couldn't answer that. So that's why I'm not with these guys here saying, oh, the cycle's all over. I can't tell you. But this chart tells you exactly what it does here and why it does it. Look at this. It's all about money printing. This is something that's Sami posted here. But money printing is exactly why we have these big bull runs that we have. And just look at this chart here. It breaks it down and makes it very obvious. I will highlight here, though, that in this chart, you do see that there is some delay. There's some delay here from when balance sheets at the central bank start to expand, which that's money printing. When that money gets printed, and then when it ends up in these assets right here. And I've explained it many times. The book really gets into it as well. Just what exactly is going on there, why the delay. It's about 6 months or so. Could be sooner, though. But basically what's happening is new dollar gets printed. It gets injected into the economy. It circulates the economy, trading hands several times, but eventually it ends up in the hands of somebody who says, man, you know, this dollar, I don't need to spend it. I'm going to save it. And the way I'm going to save it is I'm going to put it in the bank. He puts it in the bank. What does the bank do with the money? Do they just throw it in a vault? No. No, that's something that a lot of people think because Cartoon Network told them that that's what the banks do. But that is not what the banks do with your money when you deposit money into it. What do they do with your money when you deposit money into it? What do they do with it?
A legitimate question, young man, deserving a legitimate answer. Now then.
And it's a good thing that you got me and you're watching my stream because I'll tell you exactly what happens. If you watch anybody else's stream, they don't know. What they're going to do is you ask them that question, here's what they're going to say. All of the bears that are saying that the cycle is all over right now, when you ask them, well, what causes the cycle to begin with? That's exactly what they're going to say. But me, what I'm going to do is I'm going to tell you, no, what happens is when you deposit this money into the bank takes that money and puts it into treasuries or cash equivalents like treasuries. That then crowds out other investment at the low risk end of the risk curve and forces other money to invest at the high risk end of the risk curve. And what's all the way at the very end of the risk curve? Crypto. That's why. All right. That's what happens. So it's all just a matter of, if you can memorize this rule, then you're going to be good for all of your investing for the rest of your life. And that rule is the final destination of every dollar printed is a financial asset. That's where all the money ends up. That's why every time they print money, financial assets go up. It's not just because of dollar devaluation or debasement. It's because the money eventually ends up in financial assets when it's done circulating through the economy, and it ends up in the hands of somebody who has a bunch of these and wants to keep saving them, wants to keep stacking and hoarding them. Rich people like your boomer parents that aren't going to leave you any inheritance and don't want to help you out while you're struggling, living paycheck to paycheck, and they're out at the golf course, at the country club, or on their yachts, sipping martinis and enjoying life. That's where the money ends up at. Because they're the ones that own all the businesses and collect all the money. And they want to save it. Because, man, I'll tell you this, when I was a financial advisor, this was the case right here. They not only didn't want to leave money behind to their kids, but they also didn't want to spend any of the money in their retirement accounts. I'm like, hey, you got to pay for this year's expenses. I don't want to do that. Okay, but you got these expenses you got to pay for. Yeah, I know. Well, why don't you take some money out of your 401k? Oh, no, I don't want to do that. Because seeing their 401k balances go down, whether it was by forces of the market or whether it was by withdrawals, apparently it was like kryptonite to them. It was like watching, I'm trying to think of it'd be like watching really gross, disgusting, degenerate, freakish porn. That's what it was like to them. Imagine like the most deprived acts caught on camera. Okay, that them seeing their 401k balances come down even by withdrawals, that was just unwatchable to them, something that they could not stand by and let happen. Right? They acted like, I mean, it's probably like how you feel when you see the price of your assets go down. So because of that, because they don't ever want to spend the money that they've saved, which was saved specifically for them to spend in retirement, but because they don't want to do that, they don't do it. And it keeps those asset prices elevated, keeps them pushed up. This is why home prices are refusing to come down. This is why stocks are not coming down as much as we've come down. Is because the people that hold those assets refuse to take any money out of them. But as you can see here from this chart, when new money is printed, it has to go somewhere. All money that is anywhere has to be somewhere. That's another rule to remember. All money that's anywhere has to be somewhere. Either it's in the economy or it is in the financial markets. Either it's circulating from pocket to pocket in the economy or it is in investments. And when new money is created, eventually it ends up in investments, and it pushes up the riskiest investments because it crowds out investment in the less risky ones. If you can remember that, you'll never have a problem deciding where or what to invest in ever again. Now, what we're looking at here is the balance sheets of the four big central banks, the U.S., the Eurozone, Japan, and China. Let's also take a look here at this here, specifically the United States Federal Reserve's balance sheet. See, did they update this yet? I don't think so. I think 19th is the latest that they've got. Yeah, 19th is the latest because it's always a week behind. It had a pretty big drive down here because the quantitative tightening is still continuing. Thankfully, we only got 4 more days left of it, but they managed to get the balance sheet all the way down to $6.5 trillion. Now, what is the effect that this is having on overall liquidity in the United States economy? I'll show you this chart here, Fed net liquidity. You see the downtrend that it had been experiencing this whole year, starting like right here on June the 8th, or really it probably started July 20th. This whole downtrend has been the reason why crypto has been sucking as much as it has, because it went from being about 6.5 trillion or close to it all the way down to 5.5 trillion. Now, when they change the ESLR rules, that will add about $1 trillion to Fed net liquidity. And like so far, they already added about, how much did they added? They added about $100 billion in liquidity, which is not that much yet. And it will take time for it to kind of ripple out through the economy and end up in financial assets. But it's a good start here to see, just going from October 26th to today, within 1 month, $100 billion was added to the net liquidity. And what we're thinking is going to happen come next year is to be adding a lot more per month, probably about twice that amount, maybe about 200 billion, which we want more, of course, but we'll take it. Another liquidity measure here is that the U.S. Treasury General Account is still stacked up. I mean, the latest update I have on it here is from a week ago, because it's always a week behind. But still, not much of it has been spent. 957 trillion is what was there. 957 billion is what was there. 941 billion is what's there now. They're not spending this, or they're being very slow about it. And I'm thinking, well, maybe it's because they want their new Federal Reserve guy to come in first and have him be in charge at the Fed before they do any liquidity injections. And that is the man, Kevin Hassett, is who the investment markets, the betting markets, they all think it's going to be this guy right here, Kevin Hassett, which is really good. You want it to be Kevin Hassett. You do not want The other guy their name that's being passed around, which is Kevin Warsh. You do not want Kevin Warsh. Not under any circumstances at all. I hope that there is no holy way in hell that Kevin Warsh becomes the Fed chair, because he would be absolutely terrible. He is so hawkish. He makes Jerome Powell look like John Maynard Keynes. You do not want Kevin Warsh. All of the hawks love him. All of the fiscal conservatives love him. All of the a bunch of people on Wall Street love him too. We don't want no Kevin Warsh. We want Kevin Hassett. All right. His name rhymes with asset. That's why we want Kevin Hassett. Well, no, that's not the reason why. But, I mean, for one thing, look at this here. The more goofy looking the guy, the better he is at his job. He has to be, all right? I'll tell you what, the better looking the guy, the worse off he is at the job. As if you're a good looking guy and the girls like you, they're all just looking at you and they go, no. Like way back when I was a stripper, all right, working at this one club here. It wasn't a Chippendales. It wasn't a Thunder Down Under. It was a small hole in the wall place you probably never heard of. But the real good-looking guys, they didn't really have to do that much to get women's attention at the club. And they were getting money thrown at them just for being cute. All right, just for being good-looking. Whereas the less good-looking guys like me, we had to get really good at being very social, being a good talker. We had to get really good at dancing. We had to get really good on the pole and put on a great show, because we just weren't as fortunate looking. We didn't get the girls' attention just from the way we looked. Same here with this guy, Kevin Warsh, or not Kevin Warsh, but Kevin Hassett. You know he's good at his job because he's not that good looking. You have to be really good at your job when you're not good looking, all right? Now, why is he so great? I mean, let's talk about who is Kevin Hassett and why we really want him to be the new Fed chairman. He is an economist. He's a policy advisor. He worked under the Trump administration before in Trump's first term. And he helped shape the tax reform that we have now, the economic policies, a lot of them that we have right now. More recently, he was the director of the White House National Economic Council, and he had advised on a lot of domestic and foreign economic issues. He's got a PhD in economics from the University of Pennsylvania. Not that that matters, because college is a whole bunch of bull crap. But he's also worked at think tanks like the American Enterprise Institute, focusing on tax policy, public finance, macroeconomics, blah, 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 blah. He is a supply-side economist. If you haven't heard that term before, like there's two schools of thought here, or two opposing schools of thought when it comes to economics. You've got supply side, which is more in line with Austrian economics and Friedrich von Hayek, who say, you gotta make the stuff. The stuff is what matters, not the money, not the dollar bills. You can print off a gazillion of these things. That's not going to help your economy. You got to produce more stuff. You got to build more houses, build more cars, because that will bring prices down because the supply is greater. And ultimately, it is the stuff that has all the value, because if you're stranded on a deserted island with lots of food, well, you're okay. If you're stranded on a deserted island with no food but lots of dollar bills, you're not okay, because there's no supply of stuff you need. Stuff is what matters. It's what makes the economy. The opposite side of that is what John Maynard Keynes, you may have heard of Keynesian economics, that's saying, well, it's demand-side economics that matters. We need more demand. And a lot of it is broken window economics, where it's like, well, if we go out and break some windows, that will create jobs for window repairmen because there's lots of demand there. And that form of economics is crap. The system that we're under right now in the United States, it is very Keynesian, because for the most part, what gets the economy going anymore is just dumping a whole bunch of printed money into the economy. We don't like that. Hassett, on the other hand, is a more supply-side guy. He's a more intelligent guy. He's clearly the front runner to replace Jerome Powell when his term ends in May 2026. Another reason why I think 26 would be a great year. And Trump is definitely eyeing him for the role. And the betting markets, they got him at a much higher rate much higher possibility of being picked over Kevin Warsh, thankfully, and over Christopher Waller, who's also good. We like Christopher Waller. Well, Trump likes him is because he believes in lower interest rates and would also give the Trump administration much more control over monetary policy. The rumor is that the decision on who's going to replace Jerome will be announced before the end of the year, before Christmas. That's the rumor, though. Something that Besant had said. We don't know, though. But here's the real here's the real deal with this. Here is that a lot of critics think that Kevin Hassett. They don't like him, and they say he's the least qualified potential Fed chairman ever, which was this story here on Bloomberg. And of course, come on, man! Don't tell me you're gonna make me pay. Screw you! I'm not paying. Hang on a second here. You believe like these services actually think that we're gonna pay you money to read an article? Like, get lost, bro. There is no way in hell anybody is gonna pay you to read something you wrote. And this is coming from a guy who sells books, by the way. There's a lot of criticism here about him being what they think is the least qualified potential Fed chairman right here, which to me, when I hear that, that just makes me think, okay, well, he's more qualified now than anybody else because he is a supply side economist, and that's why a lot of them don't like him. They say, well, he doesn't have a lot of monetary policy experience. He doesn't have central banking experience. Good. I don't think you need it. I mean, any one of us would do a better job at the Federal Reserve than who's currently sitting there right now. The reason why they're talking so much trash about Hassett is because they believe in Fed independence, which never existed, but they believe in Fed independence, and his presence is going to undermine it. But if appointed Fed chair, his actions are mostly going to be pro-growth, very dovish stance on policy, aggressive rate cuts to stimulate the economy. He said that the current rates are too high. He made a public speech saying that. And it's stifling a supply-side boom with low inflation, and it's stifling growth in a supply-side boom. And he wants low inflation. He's advocating for cuts well below 3% to boost jobs and investment. The criticism is saying, well, the Fed needs to be data-dependent, not ideologically driven. When Janet Yellen was the chairman at the Fed, and then later became Treasury Secretary, that just shattered all illusions of Fed independence. Now, he could also steer the Fed toward more innovation-friendly policies. He's a vocal supporter of AI, automation, tech scaling to enhance productivity, and would push for lots of capital expenditure in chips and cloud computing, U.S. industrial dominance. But in crypto, he's a very bullish asset for us right here. Kevin Hassett is quite the asset here because he led a White House digital asset working group. He owns lots of stock in Coinbase, and he's publicly said that Bitcoin could rewrite the rules of finance. Now, we don't want to get too excited about this here yet because, you see, one, he hasn't been appointed yet. We don't know that he's going to be appointed. Two, Gary Gensler looked like a very pro-crypto guy before he got appointed to chairman of the SEC. And then three, we also got to remember that him being chairman is not enough to control the board. It's not enough because what we need to have happen is you need to have control of the board, which we don't quite have here because I don't think we're going to get Lisa Cook kicked off the board. I don't think that happens. And then two, we are putting a lot of hope in Jerome Powell stepping down as a governor when his term as chairman ends. Because even when he stops being the chairman, he can still be a governor if he wants to be. He could step down, though. We hope that he does. But if he doesn't, well, then we just don't have enough votes on the Board of Governors to control to control the Fed. We don't have enough votes on the Federal Open Market Committee to control the Fed. So Kevin Hassett, great as he is, if appointed, that's not enough to get things going the way that we want them to go. But it is a very good, very bullish first step. And I think it can do a lot for us here when it comes to turning around Fed net liquidity. All right. Let's look at questions. Now there's some questions being asked earlier here. Let's see. First question comes from Checks My Pulse. It says, you seem very knowledgeable in finance markets. Well, thank you. How long have you been in it? I used to work in TradFi. That's where all of this useless knowledge comes from. Is that after my career in stripping and the economy finally got better, I became a financial advisor. And before I was a financial advisor, I was also a bond broker, worked at the bond department at Fidelity, and had worked at a Fidelity branch as well. And that's where all of this knowledge came from. And that I've been doing that ever since 2013. It was when I first got my first finance job was then. Let's see. Next question here is from John Doe. Who thinks Bitcoin all-time high was an overshooting B wave of an expanding flat correction, and the top of the cycle was in January? Now, I do think that you got onto something there. It's like the way that 2024 ended, that seemed a lot more like the top to me, or that's more indicative of what a crypto bull run really feels like when everything is going up all together. I had a lot of temptation back then to screenshot my portfolio. That was in December. So that felt more like the top of the bull run to me, which is why 2025 has felt more like the bear market. So yeah, I agree with you on that, John Doe. SW asks, short-term bear market until February next year? Yeah, I think it goes on. I don't think like the real run starts until the new Fed chairman is in and the Fed really reverses course, which, they're going to partially do that coming up here in next month when they turn off quantitative tightening. I mean, that is a change in direction, not a full reversal just yet. But I do think that, yes, we are going to have a very sucky Q4 still, because in December, the carry trade can unwind. And that's why what I'm doing personally with my money is I'm not buying anything just yet. I'm stacking stables. That's all I'm doing until the 19th. Because on December 19th, if the carry trade unwinds, that's going to be an enormous buying opportunity for crypto. I mean, we're looking at $40,000 Bitcoin if that happens. All right. And then I think by June of 2026 is when enough good stuff is in place to really turn everything around. Because then we got the new Fed. We may even have experienced a disaster before then that caused the Fed to go into an emergency meeting and turn the money printer back on. If the carry trade unwinds, absolutely they will do that. They will absolutely do that, I think. Because when you see stocks go down 10% in one day, which can happen, or the circuit breaker get flipped, that's something that the Fed and definitely Trump pay a lot of attention to, and they don't want to let that happen. So if it unwinds, the money printer's back on. If not, I think the money printer gets turned back on come June 2026. All right. So that's everything I got to say here for today. Hope you guys all have a great Thanksgiving tomorrow, and we'll see you all at the very next stream.
That is it for us today, you glorious degens. Smash that subscribe button to join the rebellion, and follow me on X at ReinventIdeal for more unfiltered truth bombs between live streams. And if this was your first time listening, head over to reinventideal.substack.com. because I have a free gift waiting for you there. If you become a free subscriber, you'll get a free copy of my book, Your Parents Were Wrong, Debunking and Replacing Outdated Advice, packed with the wisdom to outsmart the system. It's absolutely free to join.